jobs day, like Bloomberg.
Believe it or not, back-to-back gains, a two-day winning streak on the S&P 500, on the Nasdaq as well. For both of those indexes, the longest winning streak of August. 2 days. Tells you a lot about August. Equity futures right now on the S&P 500 negative by 0.05%. No drama there. Likewise on the Nasdaq down about 0.1%. There's your opening bit. I'll switch to the board to get to the bond market. Yields shaping up as follows, higher by 3 basis points. Your 10-year right now 4.23. In the FX market, dollar stronger, euro weaker. A break of 108, 107.85 on that currency pair, negative a third of 1%. And crude back in the 80s in the last 24 hours, up 25 cents to $80.35, up by 0.3%. About 20 seconds into the session, your equity market more broadly on the S&P 500 almost totally unchanged. On the Nasdaq, just slightly negative. One stock to watch at the open is Chevron. Strikes at its LNG export plants in Australia could begin as soon as next week. The company said this: "We will continue to work through the bargaining process as we seek outcomes that are in the interests of both employees and the company." Abby has more. Hey, Abby.
Hey, John. So what's interesting here is the stock is not moving all that much right now. It's up about 0.4%. But where we have seen wild moves is in the European natural gas market. We've seen some sympathy in the U.S. natural gas market. But today, for instance, we have European natural gas down 7%, suggesting that traders think that maybe this is not as bad as they initially had thought, because 2 days into today, European natural gas up about 20%. Lots of double-digit moves for European natural gas over the last several days, all because of the possibility of this strike. Now, relative to it happening at 2 of these Chevron plants, that's about 5% of the global LNG supply. So it is significant, and that's why we've seen these big moves, especially to the upside. They're in a dispute. The union is in a dispute with Chevron over demands around pay and some other conditions, and it will start if they're not able to meet some sort of negotiation that is successful. They will be participating in rolling stoppages, bans, and limitations, which will escalate until apparently they believe Chevron will agree to their bargaining claims. Again, that will start next week, September 7th, if they're not successful ahead of time. And right now, Chevron down just slightly. So again, not a lot of effect on the stock, but watch European natural gas. It's been on a wild ride.
Well said, Abby. What a move we've seen in the last week or so off the back of some of these stories. Just another example of how interconnected and fragile European gas supply is right now. I want to turn to earnings. Best Buy sales slump showing signs of easing with the shallowest decline in more than a year. The CEO is saying this: next year, the consumer electronics industry should see stabilization and possibly growth driven by the natural upgrade and normalization of tech innovation. Simone has more. Hey, Simone.
Hey, John. Yeah, analysts were looking for a sign that this slowdown in consumer spending on personal electronics was ending, and that is what they got, with the CEO even saying that this year is likely to be the low point in tech demand. Domestic same-store sales came in ahead of expectations. They were ugly. They were down 6.3%, but the expectations had been for negative 7.3%. And in the second quarter, TV sales returned to growth in units. Unit sales of laptops were also flat, so not as bad. And back to school is a little better than expected. Holidays looking like the pre-pandemic levels, according to the CEO. Now, this relatively good consumer is not all we were looking for. We were looking for shrink. That was also positive, not meaningfully different than pre-pandemic, according to executives. But if you were looking for something negative, you got it here too. They lowered the top end of their comparable sales guidance for the year. So it used to be negative 3%. Now it's down to negative 4.5%. Really hit by appliance sales, down 16.1% year on year. The expectation had been for a little more than 10.
The stock is down 1.7%. Simone, thank you. Just what shape is this US consumer in right now? Depends which retailer you ask. If you ask Best Buy, things seem to be okay. If you ask Foot Locker or Dick's Sporting Goods, things are anything but okay based on their communication over the last week. That stock again, Best Buy up by 2% in early trading. Another earnings beat from J.M. Smucker, the company boosting its full-year profit guidance and topping estimates. The CEO saying our continued business momentum gives us confidence to increase our earnings per share expectations. We will continue to support our key growth platforms of coffee, snacking and pet. Katie has more. Hey, Katie.
Hey, John. Yeah, shares higher this morning. And J.M. Smucker, you probably know them from Jif Peanut Butter, but I was delighted to learn that they also make Folgers coffee and Meow Mix. Talk about a balanced breakfast. Now, net sales, they were a touch soft, but shares higher this morning after the company reported a beat on adjusted sales and profit, largely thanks to both higher volumes and higher prices. J.M. Smucker said that prices rose by 8 percentage points, so that pricing power is still there, at least if you're J.M. Smucker. Now, the look ahead, it was also rosy. 2024 adjusted EPS seen at $9.45 to $9.85. The previous range was between $9.20 to $9.60. Now, Bloomberg Intelligence had expected the sale of some of their pet food brands back in February to weigh on revenue, but you don't see that concern in the shares this morning. Currently higher by about 2%, looking at the best day since June, John.
Had no idea they made pet food, Katie.
Yeah.
Meow Mix. Who knew? I'm not going to comment on cats because every time I do, I get hate mail. Just not a cat guy, for what it's worth. Just in case you're new to this program. 5 minutes into the program, equities right now positive 0.1% on the S&P 500, almost totally unchanged on the NASDAQ. Just want to get you up to speed on some breaking news in the last 30 minutes or so. This from the team here at Bloomberg. Some fantastic reporting on the Russian President, Vladimir Putin, agreeing to make his first foreign trip since a warrant for his arrest on alleged war crimes issued by the International Criminal Court. Our reporting, according to 3 people with knowledge of the matter, saying the Kremlin is preparing Putin's visit to China for the Belt and Road Forum in October, that Putin has accepted the invitation from Chinese President Xi Jinping to attend the event, according to one of these individuals. And this, of course, happening, this reporting, right when the Commerce Secretary, Gina Raimondo, is in China for this week. I used the word awkward in the last hour. Super awkward. Let's see what the Commerce Secretary's got to say about this particular report in the next 24 hours. Another good earnings report elsewhere. Let's talk about that from Big Lots. The discount retailer reporting a smaller than expected loss. The CEO saying this: while the consumer environment will likely remain challenging and result in negative sales in the back half of the year, we're now in a position to get back to playing offense. Isabel Lee has more. Hey, Isabel.
Hey, John, quite the bullish statement from the CEO. So the company posted a better than expected loss in the second quarter. Big Lots reported an adjusted loss of $3.24 per share. That's down 42% last year. Revenue fell 15% to $1.14 billion. So both metrics were much better than analyst expectations. And the CEO also said that while this result was optimistic, the results illustrate that we remain in a challenging environment, especially for their core lower income customers who have limited capacity in buying big ticket items. So what is the big picture here? That consumers are still squeezed. Ahead, Big Lots expects the comparable sales down in the low teen range, that it's improving modestly from the second quarter. Now shares are up around 17%, John, so that's quite a jump.
Stock doing nicely. Isabel, thanks for that. A 17% move on Big Lots this morning. I'll get you some data on that, on whether that's the biggest one-day drop since, one-day pop rather, since June 13th, 2023. That just dropping across the Bloomberg right now. Amy Silverman thinking the market has reached its peak on tech and AI, saying this: only a few months ago, the biggest fear in the market was FOMO. Now the opposite is happening. We're seeing increasing signs of bearish sentiment in the NASDAQ and declining signs of bullish sentiment in stocks like Nvidia. Amy, I'm pleased to say, joined us now for more. So Amy, that's the question you've been trying to answer. Have we seen peak exuberance in US tech? Amy, have we?
I think we have. If you look to the options market, John, it's actually quite funny. If you think to the beginning of this year, consensus was overwhelmingly bearish. And so then a few months ago, folks were forced to jump into the pool. And as we know, momentum begets momentum. You've really seen that cycle happen kind of during the pandemic, to a point where, it's not even odd anymore that we get these huge outweighings of call demand relative to put demand. And when you see that cycle happens, it takes a while to run through, but we are seeing those indications now. That call demand is really shrinking relative to that put demand, whereas that put demand is rising in mega cap tech.
Amy, you and I have talked about this a million times. It's not just about data, earnings, it's about how the market responds to those things. You mentioned Nvidia. What can we learn about how Nvidia, the stock, responded to Nvidia, the earnings, which were tremendous relative to expectations?
Yeah, it's a very interesting question, and I think you've had a lot of folks on, who've pointed to the fact that the first time we had those blowout earnings, we had a blowout stock move. But the second time we had those blowout earnings, we didn't get that blowout stock move. What I would say in relationship to that from the derivatives market is you're also not seeing that cycle of call options invert skew. So the call demand outweighing that put demand, that is a sign of that cycle continuing, and we're actually seeing that sign shrinking in NVIDIA, but not only in NVIDIA, in names like Apple, as well as Microsoft, as well as the NASDAQ in general. So to me, it sort of almost says, well, everyone's in the pool, so now what? And that's the question of whether that momentum flags from here.
Amy, let's talk about September then. Wrapping up August, amazing that back-to-back gains on the S&P 500. The longest winning streak of August so far because August has been so tough. What is it about September, Amy, in difficult markets?
Yeah, so, I still like to look at the seasonality of the markets, especially for volatility. And I think because so many people go on vacation in August, people actually forget that seasonally August is actually a time where volatility rises. That also happened this year. And then September is another time for volatility to rise. You just look to, back to school in the first few weeks of the year. You have a lot of the industry conferences. You have a lot of other economic single stock and macro data happening, and just physically more volume coming through. I do think we'll see another environment where you're not only going to get that volatility rise, but, going back to everyone's in the pool now, you do get that question of, is it time to hedge with only a few months remaining before we close the end of the year?
I'll ask you that question right now then. Amy, it's paid off big time to be long the S&P 500 year to date. You know that. Everyone does. Do you think it's going to pay off to lean the other way?
I struggle with this question, John, because usually, I can point to options and say, look, these option strategies have been so attractive. Unfortunately, if you look today at every single option strategy, you've actually just been better off being along the S&P. I don't like to have to say that as equity derivative strategist, but it is true. I do think there is an inflection happening because it always comes down to positioning. And if you have people now who have benefited from that FOMO and have benefited from that rise in mega cap tech, I think the question they're asking themselves now is, do I protect my portfolio? Which was not the question they were asking perhaps a few months ago. So you could see that demand rise for hedges.
It's a change. Amy, appreciate the honesty as always. Amy, Will Silverman there of RBC. We're about 11 minutes into the session. Let me give you the wrap up of things right now. Potentially a third day of gains on the S&P. Really mild muted stuff though, by 0.1%. A very, very small move lower on the NASDAQ by 0.05%. Outside of that, into the bond market, two-year yield still just about 5%, up by 2 basis points today to 5.02%. A sixth day yesterday, the two-year closed above 5%, a sixth consecutive session. Let's see if we make that day 7. So yields a little bit higher, dollar a little bit stronger, push through euro right now, and you see euro dollar at 107.95. We're negative by 0.2% on that currency pair. Coming up on this program, banking in focus as the FDIC explores new regulations.
50% of the S&P is above the 200, 50% is below. It's a very, very split tape. What I don't like is on the wrong side of the split tape, you have some pretty important groups like banks.
But a tough month for the banks, even with that sell-off in the Treasury market. Typically we talk about higher rates helping out the banks. Not this time around. We'll talk about that next.
You go name by name. It's just odd to me that Citigroup is back on the lows, Bank of America's right there, Goldman and Morgan Stanley look weak, and we know the regionals have rolled. 50% of the S&P is above the 200, 50% is below. It's a very, very split tape. What I don't like is on the wrong side of the split tape, you have some pretty important groups like banks.
It's been a tough month for the banks on the S&P 500. Chris Verone there, Strategas, weighing in on the banking sector. The banks, the post-SVB high a couple of months or so ago, we're down about 9% from there. Bit of news on the banking sector overnight. The San Francisco Fed's banking supervision chief, Azar Abbasi, announcing his October retirement. He had oversight of failed lender SVB during its collapse. This is the FDIC is set to meet today at 10 a.m. Eastern time, so about 15 minutes from now, likely to propose new rules requiring mid-sized lenders to issue sufficient long-term debt to cover capital losses. Your team coverage starts right now with Bloomberg's Mike McKee and Shanali Bassett. Mike, some moves at the San Francisco Fed.
Yeah, this is not being explicitly linked to the bank failures earlier this year, but it is certainly not a surprise that somebody might be leaving the bank. As you mentioned, Azar Abbasi was Executive Vice President of Supervision and Credit at the Federal Reserve Bank of San Francisco. He was responsible for the group that was overseeing SVB. SVB obviously went down in flames, and Michael Barr, the Vice Chairman for Supervision at the Federal Reserve Board, put some of the blame on the San Francisco Fed, but also some of it on the board in Washington, and he has promised reforms that will try to bring the two sides closer together, the two enforcement groups closer together, and also change some of the supervisory practices that are used to try to keep the banks out of trouble. So again, Azar Abbasi was in charge of the group. He is retiring. People can make the conclusion that they want.
I think people are drawing some of those conclusions, Mike McKee. Shanali, it's been a number of months since these banks failed. We've spent the last 3-4 months talking about what next on the regulatory front. This FDIC meeting that starts in about 12 minutes' time, Shanali, how important is that?
It's very important because we're watching rules that are hitting banks with $100 billion of assets or more face regulations that they have not seen in many, many years. Now, remember, when you take a look at what's actually happening today on top of the Basel III requirements, you have the United States, the FDIC, wanting them to increase their long-term debt requirements. The reason they're doing this, John, is because you're watching an issue here with the Deposit Insurance Fund taking a hit this year with those bank failures. And you're watching the chair of the FDIC say no more. We want to make sure that this does not happen in the future, and they want to avoid the systemic risk exemption. So what does this mean for the market? It means that the banks could face about $157 billion shortfall, according to analysts at Bloomberg Intelligence. U.S. Bank, PNC, Truist, the most exposed among those banks. Now, New Edge Wealth, Ben Emmons makes an interesting point here in an email to me this morning, which is that these banks, many of the system right now is still on life support. Bank borrowing from the Bank Term Lending Facility over at the Federal Reserve to the tune of over $100 billion. Now, in addition to that, they're going to have to increase their borrowing and therefore their borrowing costs at a time where you're also facing a lot of downgrades for the banking system.
Shanali, this is the mid-sized banks. What about the big names we're all familiar with, the JP Morgans, Bank of Americas, the Citis of this world?
Well, they also face more rules by means of Basel III Endgame. They are in the process of fighting a lot of those proposals, but you also have to take a look at not just those. Let me take a contrary point of view for a moment here. You have Wells Fargo pointing out the banks under $100 billion in assets here that might face less regulation, that might become more attractive in the future just because of their pure size and ability to cater to smaller markets more directly. But to your point here, the big have only gotten bigger in the midst of this crisis. They will also face more rules, but they also have more money to set aside here and lower borrowing costs in order to weather these new regulations better than those mid-sized banks above $100 billion in assets.
Mike McKee, we've both just returned from Jackson Hole. You were there through the weekend. I think maybe once this came up in conversations. Can you imagine that back in spring if I said we'd go to Jackson Hole at the end of August and it would be barely talked about, those banking failures?
A lot of people were expecting it to be a systemic problem that spread throughout the banking industry, but it didn't. It was confined to basically the three banks that went under at the time, and it does seem to show that even with the problems that the bank supervisors have, the U.S. banking system is in much better shape, much stronger than it was certainly in 2008, 2009.
Mike, before you run, I want to squeeze this in just on home prices, just quickly. Home prices in the U.S., according to the data this hour, climbing for a fifth month. Mike, where does this leave the Fed's effort, given what we know is happening with the mortgage market and how nuanced, unique, idiosyncratic, dare I say, the situation is?
Well, it's kind of an interesting situation because prices are going up, but nobody's buying houses, really. That's why prices are going up. It's a supply-demand issue. So if we aren't seeing a lot of turnover, even if prices are higher, it's not going to have the major impact it would have, say, when we saw in 2005, 2006, when home prices were going up so much, and they created a bubble. So it is a concern in terms of the long-term health of the housing industry, but not a major concern for inflation right now.
Mike McKee, thank you, sir. Alongside Shnali Bassett, the latest on the economic data, housing prices and the banking effort, the regulatory effort, which is going to kick up into high gear in about 9 minutes' time. About 21 minutes into this session, your equity market looks a little something like this. Third day of gains potentially on the S&P 500. The session is young, so early days here. On the NASDAQ, potentially a third day of gains as well, up a third of 1% on the NASDAQ. Into the bond market, yields a little bit higher at the front end of the curve by a basis point or two, just north of 5%. And in the FX market, the dollar just a touch stronger against the euro. The euro in the last couple of seconds just about reclaiming 108. Let's get you some sector price action. Here's Abby.
Well, John, if we do get that third day higher, it will be the first time we'll have seen that in the month of August. It will be the best three-day stretch since the middle of July. As for what's happening on the day, relatively small moves, as you pointed out, early times in the day, but we have some of those mega cap tech sectors up top, discretionary along with communication services, very small losses on bottom, energy, real estate, industrials. If we take a look at what's happening on the month, though, because it is the worst month of the year for the S&P 500, 10 of the 11 sectors are lower. Energy remains the one sector that's higher, and of course we do have some of that volatility in natural gas that we were talking about earlier, driven by the LNG strikes. But take a look at the financials that you all were just talking about, down 3%, materials down almost 5%, utilities, that is the worst sector on the year, perhaps having to do something with Hawaiian Electric, but also with yields higher, well, those dividend-rich stocks, they just don't look as attractive, John.
Getting beaten up by treasuries over the last month. What a move we've seen, particularly on the 10-year yield, not just the 2-year. Abby, thanks for that. Coming up, tons of jobs data in America. Your trading diary up next. Three-day winning streak on the S&P 500, the longest winning streak of the month so far for the month of August, as we wrap up this month and look ahead to September. About 25 minutes into the session, advancing by, let's call it, 1/4% on the S&P and about 0.5% on the NASDAQ. There's the price action. Here's the trading diary. Coming up, FDIC board members meeting at the top of the hour on new banking regulations. We'll also get job openings data and consumer confidence. US GDP numbers coming out on Wednesday, another round of jobless claims, and the PCE deflator coming up on Thursday. And Friday. It's the main event, drum roll into Friday before the long weekend. If you stick around for that, it's payrolls Friday, this Friday. And the expectation in our Bloomberg survey, the median estimate so far, 170,000, just down a little bit from 187, as the Fed would say. They call that progress. Further signs of progress in the labour market, trying to take some heat out of this, reduce inflation and engineer that elusive soft landing, whatever that looks like. That does it for me. Thank you for choosing Bloomberg TV and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Tuesday, August 29th. Here are the top market stories we're following for you at this hour. China's drip, drip, drip. The country's largest banks could cut interest rates again to shore up growth again, with none of it really working. And a jolt of confidence. We're going to get the latest read on the economy with instant analysis from Dana Peterson, chief economist of the Conference Board. And what data do you care about? So volume is anemic. Yes, stocks are eking out a gain. There's a lot of risk out there. We're going to see what data this week can actually shake up markets. From New York, I'm Alex Steele with Danny Berger in London. Guy Johnson is off today. Welcome to Bloomberg Markets. Danny, thank you so much for being here. I really want to get excited about the price action. There is a lot of data coming out, but man, volume is light.
Volume is so light. Yesterday was the lightest day for the U.S. that we've had in some time, a record level if you take into account, or if you don't take into account those half days. It kind of comes back to all of the data we get this week. Alex, how much risk do you really want to put on a volatile summer month ahead of some potentially game-changing figures?
Yeah, and when September is already sort of not a great month for stocks anyway. So speaking of the data, we get some of that right now. We get JOLTS and consumer confidence numbers crossing the Bloomberg. Here is Michael McKee, who's parsing through the data. Mike, what do you got?
Kind of a mixed report, Alex. We've got consumer confidence falling more than anticipated to 106.1 from 114, a revised 114. The forecast was for 116. So even last month revised below what the forecast was going to be. Present situation comes in at 144, down from 153, and expectations at 80.2 from 88.0. Now, the number that economists tend to look at here, especially in employment weeks, is whether people think that jobs are easier to get or harder to get, and jobs plentiful falls to 40.3 from 43.7. Jobs not so plentiful rises only a little bit to 45.6 from 45, but jobs hard to get, 14.1 from 11.3, so a deterioration that may weigh on people's forecasts for Friday's jobs report. And then we have the JOLTS jobs opening number. Now this one is good news for the Fed. We fall to 8,827,000 from 9,165,000, which is even revised lower from the prior month. And that is considered good news because the Fed's been looking at all those jobs that are out there and saying the labor market is really tight. Prior to the pandemic, we were in the 7 millions roughly. The rate of hires changed little, 5.8 million, and the rate of hires 3.7%. Separations, layoffs, quits, and discharges are little change, they say. The number of quits decreases to 3.5 million, and that's a 2.3% percentage rate, but that is, as we say, little change. So Americans are still quitting, but not as many as they did before. Little less confidence in their ability to get jobs.
And also apparently less confident in general. Hey, Mike, great stuff. Thank you for the breakdown. Bloomberg's Michael McKee. And you can just see the market reaction, right? You get equities giving a pop higher. You have a bid now coming into the bond market. The 2-year yield is down now by 6 basis points. So that didn't take long. Let's get the instant analysis now with Dana Peterson, the Conference Board chief economist. Dana, what happened here? What's going on?
Well, consumers are definitely less confident in August relative to a few months ago. Indeed, we saw the confidence measure downwardly revised in July, and we basically erased gains from the last 2 months. Consumers are more concerned about inflation. They complain about food prices, gasoline prices, inflation in general, and they also are less optimistic in terms of the labor market going forward.
So does that mean consumers aren't as confident that if they quit their job, Dana, that they'll be able to get a new one? Is that a fair reading?
I think that's accurate, and certainly when we look at the JOLTS data, we see that there are fewer job openings. So that means consumers are saying, look, there aren't as many options out there. Maybe I should start sitting tight, especially since wages are not rising as aggressively, and we're starting to hear a little bit more in terms of softer employment. So I think all those things together are making consumers a little bit less confident than they were certainly a few months ago.
I guess I'm just wondering kind of what changed, because none of the other data that we've gotten would necessarily mean everyone's really freaking out and tightening their belt. So put that into perspective for us.
Sure. What's different is certainly consumers are paying more for gasoline, and they are paying more for food. So those two things really put a damper on consumer finances, which were not as great as they have been in the survey, both currently and also looking ahead to the future. So that's definitely different. And also in the labor market data, you know, we are going to get payrolls this month, but payrolls last month and also in revisions have been revised downward. And so consumers are hearing about this, and we think that they're getting more concerned. Also, consumers are probably concerned about what they're hearing in the stock market. Banking stocks are down because of downgrades, and maybe that's also feeding into the psyche. We didn't ask that question, but it certainly could be a factor.
Dana, you didn't mention this, but I gotta imagine mortgages also must feed into this. Past 7%, a housing market that feels essentially frozen. Do you see any feelings of limbo among consumers given the housing market?
I think so. And when we look at their expectations for interest rates, their expectations rose. So they think the Fed funds rate is going to be higher. They also think stock market gains are going to be lower. And certainly when we asked about housing, they're still saying we're not really planning on purchasing homes. So yes, mortgage rates probably are playing a big factor into how consumers think about the housing market. And we're seeing it evident in the housing market itself in terms of existing home sales down and very little action in new home sales.
Hey, Dana, I'm curious as to how this will affect savings rate. So do we imply that if there are concerns, the saving rate gets drawn down more and provides less of a cushion, or do we stop spending the savings altogether, and that's sort of, you don't have that extra juice anymore for the economy? What do you think?
Well, when we look at excess savings, which is all the money that consumers received throughout the pandemic, it topped out at maybe $2.2 trillion in real terms after adjusting for inflation. In the last reading, in the second quarter, is around $730 billion. We think they're going to run out of that money this quarter. So definitely they're running out of options in terms of spending. They're looking at credit cards, and credit card debt has risen to $1 trillion, and we're back at pre-pandemic levels. And certainly when we look at delinquencies, those are also back at pre-pandemic levels. So consumers are headed for some trouble, we think.
Dana, there's this great report from the Brookings Institute basically saying that consumers are spending the same amount that they were just immediately post-pandemic, suggesting that the rate at which they run out of cash is likely to be higher too because of that level of spending. Has that level of spending, have you seen that maintain itself? And are we due for a really sharp drop-off because of that?
Well, when we look at spending in general, year on year, it's been slowing. Certainly, a lot of the spending that people are engaging in is shifted to services, but it's not as aggressive. And we do think that there will be cliffs here. Student loan repayments, at least on the interest, will probably come back in October. Like I said, the excess savings is going to run out now, and consumers are building up quite a bit of credit card debt that's going to be due at a higher interest rate. So we do think that consumer spending is going to be very weak and will contribute to a recession probably by the end of this year or early next year.
Hey, Dana, thanks a lot. Really interesting take. We appreciate that instant analysis. Dana Peterson, the Conference Board Chief Economist. Guys, I mean, I don't know how much to make of the price action, but equities are flying now. Yields dropping like a stone, particularly in the 2-year, down by about 8-9 basis points. The dollar also just totally tanking here. The Bloomberg Dollar Index is down, and you see 12 basis point move on the 2-year. I mean, I appreciate that this volume is going to be very light, so I don't know what the real action is, takeaway is here, but you can definitely see that it is a dovish takeaway if you were going to be playing the Fed off of this data. Other breaking news for you, the FDIC announcing some new long-term debt limits for mid-sized banks. We've been waiting for this to come down. Sonali Basak has the latest. Sonali, what do we get?
There are a few things to understand here. One, that we knew that the long-term debt requirements would apply to banks with more than $100 billion in assets. Importantly, these requirements would be phased in over 3 years. That multi-year phase-in period, we believe, and analysts have said, that it would buffer the blow here when it comes to the increased cost to banks. Now, prior to the rule, Jefferies had come out and said that this could have a real impact to net interest income as well as to earnings per share for a number of banks. That hit could be anywhere between 1% to 3% of earnings. So this 3-year phase-in period is important as far as what the FDIC is saying. There's importantly also a statement that says the new requirements does not result in additional requirements for what they call TLAC, that is total loss absorbing capacity for these mid-sized banks. However, it will potentially lead to a very significant deluge of issuance. Prior to the rules, Bloomberg Intelligence estimated more than $150 billion, with some of the mid-sized banks, the bigger ones, U.S. Bancorp, PNC, leading the way in that issuance.
And Sonali, I was going to say not too much of a reaction in share prices just looking at some of these regional banks. Is that because everything was as expected? Were there any surprises in what we learned? It's
really the fine-tooth comb here in terms of the details. That phase-in period is important, as I was saying, as well as this idea that they don't have more requirements for TLAC on top of this long-term debt requirement, which has been telegraphed. You think back to a speech by the FDIC chair a while back. Now, remember, the reason this is being done, Danny, is in part because the Deposit Insurance Fund took a significant hit after the failure of a set of U.S. banks. And remember,
However, when the deposit insurance fund does take a hit, the banking system pays for it. And so at the end of the day, it's a bit of a net-net situation because you have to pay anyways if things were to go wrong. And the reason this is happening is to make sure that for any potential future failures, that these banks are covered and the FDIC wouldn't have to take as large of a hit.
Shanali, thanks so much for the roundup on those lines. Bloomberg's Shanali Bassick. Now coming up on the show, our question of the day. What data shakes the market? We've already got a nice dose of it this morning with both the dollar, stocks, and yields jumping and moving on that JOLTS data. We're going to be speaking to Caterina Simonetti of Morgan Stanley Private Wealth Management. She'll be joining us next. This is Bloomberg.
All eyes are on the U.S. jobs report.
We're still seeing some lingering effects of the pandemic on the jobs market.
There has been a shift to labor, and it doesn't seem to be diminishing.
This labor market is still tight.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
Are we beyond COVID?
We are on that path to get to lower inflation by the end of the year.
But then you look at the unemployment rate, you're looking at a problem for the Fed.
The August jobs report, Friday on Bloomberg Television and Radio.
Recent data definitely moving markets. Just about 10 minutes ago, you got JOLTS, a bigger than expected drop. Maybe the Fed is closer to the end of its cycle. You also have consumer confidence dropping, right? It is affecting the real economy. And you're seeing equities move higher. You're seeing yields drop like a stone. The dollar also reversing as well. Caveat, volume is still really low. Like 4 people are trading right now. But it does set us up for a funny question of the day. So coming into today, we were like, well, what's going to shake up the market, right? Like volume is low. What's the data? Maybe we just saw it. Maybe it was JOLTS. Caterina Simonetti, Morgan Stanley Private Wealth Management Senior Vice President, joins us now. Caterina, what data shakes the market this week, or did we just get it?
Well, Alex, there are very active 4 traders that are affecting the market right now. It certainly seems that way, but perhaps we just saw it. The drop in consumer confidence is not something that is entirely unexpected. It's hard to be confident in the environment where interest rates are high, where inflation was high for such an extensive period of time, and it was quite unexpected. And the credit availability, is tough. So it's only natural that consumers are in this environment, are feeling slightly less confidence. But the question is this the data point that Fed needs to get near the end of the tightening cycle? Because we're hoping that they're going to take a pause, but of course there is a strong possibility that they're going to continue, to raise rates. So hopefully this is going to be the data that will get us closer to the end of the rate hikes.
At least equities seem to think that, Katerina. I mean, dollar folds like the paper it's made out of. Equities take off. Bad
Wow,
news is
good
news.
That was really good.
Thank you. I did just think of that. You guys can steal it. But equities take off. How long are we going to be in this window of bad news is good news? Is there a point where that's no longer the case?
Well, Danny, what has been unique about this market in the first 2 quarters is that it has been driven by very specific sectors. And even within these sectors, the concentration of growth has happened within this very big 7 or 8 names. And we know that that's generally not typical. The question is, how sustainable is that growth? So when we look towards the end of the year, we think that, absolutely it's possible that we're going to continue to grow, but our expectations are not entirely optimistic. We're expecting some type of low single-digit growth, if we get it. And, we are telling investors to stay within the areas that are defensive, that allow companies to have this pricing power and competitive advantage. Take close attention to valuations, because that's what it will take to be successful in this market.
So I appreciate that you're longer term. I get that. But I mean, in the next couple of days, if we get a hot jobs number Friday, does this automatically reverse? Like, is that the environment that we're going to be in, though, in the next week or so?
Well, Alex, the question is, if data is all good, does it mean that we have to, just say goodbye to the stocks that have done so well for us? Absolutely not. Because, again, we are expecting that growth might continue, but what do we do to prepare, for either outcome, right? Perhaps we take some gains off the table. Perhaps we diversify the equity positioning a little bit, look more at the large caps versus small and mid. There are certain things that we can do to position ourselves so we both take advantage of growth and can position ourselves to do well in this market, but at the same time don't be quite so foolish about it as to be concentrated in just very specific areas and chase returns. We should not be doing that.
Do you want to go abroad at all, or is the U.S. the only game in town when you look at European data start to disappoint more than it has been already?
Well, when we look at U.S. valuations, the one thing that we're seeing is that some of them are still a little high. And in contrast to that, when we look at large, well-established companies with this, kind of global exposure, valuations over there certainly seem attractive. And, it's a little scary to go there. It's a little scary to, to make that call for international exposure. But we absolutely are seeing opportunities both in developed and emerging markets. We just have to be very careful with security selection and select what we own.
Katerina, where in EM? I mean, is that a China play or like an anything but China play?
Well, there are opportunities in the China play, and there are also, emerging markets. We tend to think of emerging markets as just China, but it's just there's, much more to it than that. So certainly India, as we look at the global market and as we look at the, opportunities and, specifically in energy, in materials and commodities, there are places outside of China for sure. We shouldn't just be focused on one sector.
Katerina, going back to what you said about looking for companies with pricing power, our quant team over on the Bloomberg data side, headed by Steve Hu, has this really good study showing just how much stocks with pricing power have outperformed. Is that a type of factor that will basically, you want to play that in any environment, or is that a very much so downturn concern about the economy type of play?
Well, a little bit of both. When we look at the second quarter earnings, they have been mixed. But more importantly is forward-looking projections, even for the companies that have done very well, have been cautionary. And we can't really ignore that because it is going to be all about the earnings. And it's much more difficult to be profitable in the environment where interest rates are high and credit is hard to get. So that's where the pricing power and overall competitive positioning is going to make all the difference in the world. And, that's why we look at the sectors like, financials, like industrials that are fueled by government spending, materials, healthcare, for these, exciting opportunities. Because look, as tempting as it is to invest in sectors that have already done well and kind of just get on the bandwagon, the smarter thing to do would be to invest in the sectors that have not done well and are positioned well specifically because of that pricing power.
Beyond the bandwagon. Katerina, thank you so much for joining us. Katerina Simonetti of Morgan Stanley
You're just,
Private
coming up
Wealth
with these
Management.
like crazy, Danny. You're just like, you're on it. Well, what was your dollar thing?
It's because I said it folded like the paper it was made of. I'm feeling very poetic today, I think, Alex. I think that's it.
It's because you had a 2-week vacation. This is what happens.
That's it.
And that's exactly it.
Yeah, exactly. My head is clear. I'm going to clip this up, send it to our bosses, and advocate for more 2-week holidays. All right, still ahead. It's unprofitable, it's thinly traded, yet its market cap is bigger than some of the biggest names on the Dow. We're going to be looking at the Vietnamese EV maker VinFast in today's The Startup. This is Bloomberg.
It's 23 minutes past 7 on the West Coast. When I get to the startup, where we cover the top tech stories from the Bay Area and beyond. As Silicon Valley starts its morning. Joining us here, though, on set in New York is Bloomberg Technology co-host Caroline Hyde. Caroline, can we talk about VinFast for a second?
Can we?
I mean, is this the new meme play? These kind of moves that we're seeing?
Only 1% of the stock is traded. 99% is still controlled. Yeah, still controlled by the founder, the wealthiest man in Vietnam. Look, we can go through all the numbers. The fact that this is a company that is still loss-making. The fact that this is a company that's going to be trying to, well, double its 24,000 cars made in the entirety of 2022. And it's currently worth more than Boeing. It's worth more than Goldman Sachs. This is a company that is trying to make ground in the United States, trying to make manufacturing here. That's why it's listed, of course, via a SPAC, but a couple of weeks ago. And this has yet still had to recall all of the particular automobiles that it made, the EVs it's made, that it sold in the US. So this is a company that is not exactly a surefire bet. However, it is currently worth $163 billion at last count, more than Disney, more than Goldman, and many are just trying to question why this has happened.
Yeah, that chart is kind of insane. I have to say, and I have to be honest, I literally had no idea what VinFast was, but it just so happens I spent the last 2 weeks in Vietnam, so I learned quickly, and I literally saw so many VinFast cars when I looked out for it. But I actually asked someone there about the IPO, and he said, I'm not into it because here in Vietnam, barely anyone can afford a VinFast car. They're going to buy BYD. They're going to buy a cheaper Chinese electric car. How much competition is this company facing from the likes of those Chinese EV makers?
I mean, when you're just looking at BYD's numbers today, shares really rising higher when you're looking at the ADRs here in the US and particularly outperformed over in China, because this is a company that's making and selling 700,000 EVs vis-a-vis 24,000 over the course of an entire year. Yes, the competition is hot. We know that there's also a lot of pricing issues going on, particularly in sales in China. We know Tesla's been drawn into this price war in particular, and it's notable that when VinFast in particular is making a play on the US, look, that's why they IPO'd in the US. It's about brand building. It doesn't have much of a brand here in the US, and when you're pricing a car at about $46,000 for the SUV, that is a crowded space, and that is about the same price point as, well, Ford's offering in an EV Mustang. So no wonder people are going to be questioning whether really you want to be making a bet on a company that ultimately, as we've just said, has had to recall all of the automobiles that it sold here in the United States because of some software issues thus far.
Yeah, doesn't sell well in Asia because of competition, not so good in the U.S. Difficult market for them. Caroline, thanks so much for that. Bloomberg's Caroline Hyde. You can, of course, catch Caroline and Ed Ludlow on Bloomberg Tech in about 90 minutes. Coming up, we're going to talk jolts. This is Bloomberg. All right, some serious breaking news here. A U.S. court has now paved the way for the first Bitcoin ETF in a ruling that rules for Grayscale. Bitcoin jumping after this moment, a huge run up here. Grayscale also moving higher, Coinbase moving higher. So the SEC last year
had rejected Grayscale Investments' plan to convert its Bitcoin trust to an ETF, the most hotly waited for physical ETF. They said that crypto markets are too ripe for fraud and manipulation. Grayscale then sued, and then now we have the D.C. Circuit Court of Appeals potentially overturning this decision that the company had called arbitrary, and this would very much pave the way for a Bitcoin ETF. Grayscale Bitcoin Trust jumping 17%, Coinbase jumping, Bitcoin jumping. We're going to have more on this in just a moment, but definitely a huge moment for crypto. All right, let's get to other trading moments, trading stocks, whatever, the trading session right now. Abigail, do a little tracking the moves because we're seeing some pretty big moves. Volume, though, still quite light.
We are, and here is another jump. We do have some trading here for the S&P 500 over the last 3 days, the best 3 days since the middle of July, the only 3 up days in the month of August because of the declines that we've had, up 2.1%. And we've, of course, been tracking the S&P 500 within a chart, still below the 50-day moving average, but the S&P 500 is trying to take out the August downtrend, so it's going to be an interesting battle ahead. As for what's really outperforming on the day, China Tech on more China stimulus up nearly 4%. You can also see Apple getting a nice bid for certain. Nvidia up 3% after so much selling, sell the news from that blowout quarter. And then Tesla up 4.7%. Let's take a look at the NASDAQ 100 because the NASDAQ 100 is holding the uptrend. So here was some consolidation in March. When we first showed this chart, we were suggesting that we could see some consolidation now. We certainly have that consolidation, but you can see the NASDAQ 100 rising higher, the RSI coming up. It's a really interesting moment to see whether or not the near-term buyers are going to take out some of the selling pressure. This chart may suggest that could be the case, and we'll be bringing the Bloomberg Dollar Index back into the conversation at some point soon. And then we, of course, have some of the big pharma companies trading in a mixed fashion. Johnson & Johnson down ever so slightly, but Amgen, Bristol Myers Squibb, and Pfizer as some of their big blockbuster drugs, well, they are on the Medicare negotiation list. It's interesting to see this price action. It's not exactly what I would have expected, Danny.
Yeah, I mean, Abby, how much of a turnaround have you seen on this equity market post the JOLTS opening? How much does it seem to you that it's shaken things up, and how much of that do you think is just due to thin volumes?
I don't think it has so much to do with the jolt, although in some ways, just given the fact, the bad news is good news, I think it's more that we've had the consolidation in the month of August. The buyers are taking stock, seeing whether or not they can retake control of the market off of the last couple of days. I think that the technical forces, Danny, more at play here.
Okay. Abby, thank you so much. That's Abigail Doolittle there giving us the market roundup. Alex, again, these lines we just got on the courts potentially overruling an SEC decision that said Grayscale, sorry, you can't turn your trust into an ETF, potentially overruling that, allowing Grayscale to have an ETF. The timing is also interesting because I just want to point out the SEC is also expected to respond from filing from Bitwise, BlackRock, VanEck, WisdomTree, and Invesco on their ETFs just before the Labor Day weekend, which is, of course, next weekend. I can't help but wonder if the courts have done that. Does that just open the way for the SEC saying, okay, yes, we're going to approve these now?
I mean, wouldn't you think? Because otherwise, are we just looking at the SEC saying no thanks, and then for the lawsuits just to continue and it winding up to being the same thing anyway, Danny? But anyway, this is a huge moment for crypto.
It is. It really is, and we've had so many filings recently, so many crypto bulls waiting for this moment. Let's get more on it with Bloomberg's Shonali Basak, who joins us now. Shonali, put this in context. How big of a decision is this on Grayscale?
It's massive. This has been a years-long pursuit for Grayscale. Remember, it has been fighting the SEC's decision, and now it has the courts in their favor. If you look at the Grayscale Bitcoin Trust, this is the main entity that would face the conversion. This is one of the longest-standing, largest trusts holding Bitcoin, in which retail and institutional investors have been able to gain exposure for many, many years now. You are looking at discount to net asset value really narrowing here. At this very moment, it stands at about 24% under its net asset value, but that is expected to narrow as they get closer to the ETF conversion, which has really become a main thesis for investing in this fund. And beyond that, as you're saying, there is a whole host of other ETF filings in the pipeline, and this is boding well for those firms. I will also say that in addition to the Grayscale Bitcoin Trust finding some love on the heels of this decision, you're also seeing Bitcoin itself up above 27,000. It's almost 5% jump in the market right now, because the idea here is that by a potential conversion here for the Grayscale Bitcoin Trust into an ETF, it could draw massive adoption from financial advisors, retail investors. Think about how much money on the sidelines could be sitting there from the likes of the large wirehouses that could become more comfortable about putting their clients into a regulated ETF exposed to Bitcoin rather than spot Bitcoin itself.
As Danny was talking about in terms of the pipeline, though, I mean, does this mean the SEC is like, well, all right, fine, you all get it, or they're still going to be case-by-case basis, and is Grayscale then different?
That is the massive question here, the order, because we have seen from the other products out there linked to cryptocurrencies, the first ones out of the gate have had massive adoption by a landslide. So first out of the gate matters a lot. There's a lot of discussion about how the SEC handles this pipeline, because the idea here is not to make the same mistakes as we've seen in prior products, where the first ones out of the gate got a lot of inflows and then the other products tend to lag behind. The idea here is choice, and investor protection partially means also choice for investors.
Interesting. I was going to say that we've heard from the SEC time and time again, even Gary Gensler on this very program, talking about fraud being rife within crypto. Can they allow more ETFs to come through, allow more trading, and also at the same time try to accomplish that aim of protecting consumers, like you mentioned?
The difficult part of this is that the ship has already left the station, hasn't it? The train has left the station. You're looking at the industry outside of spot Bitcoin really boom. Outside of spot Bitcoin, you're looking at the derivatives market having boosted meaningfully, with the futures market and futures ETFs haven't taken off in such a meaningful way. There's been a massive debate about that, Danny. Is it safer to be investing in the derivative products, or is it safer to have this more direct exposure to spot ETFs? This is partially a byproduct of the CFTC moving faster.
Were we in a world where certain asset managers couldn't allocate unless it was in a form of sort of an ETF?
Partially custody has been a huge problem, and the idea of could or couldn't, it's will or will not. You've seen some of the biggest wirehouses in the world be really reticent, the biggest banks be really reticent to adopt crypto in a meaningful way, and really be reticent to push their clients into these products without a more regulated market and without safer wrappers like an ETF. And so there is a significant sense that more money could come in through the ETF wrapper because those custody issues are not as pronounced. It makes it easier for that everyday investor to get involved in these products.
Shonali, I feel like you speak to a lot of Bitcoin bulls, some who have sort of wavered in that bullishness. When you speak to them about the catalyst of spot Bitcoin ETFs being approved, how big of a game changer do they see that for the impetus for Bitcoin to move higher? How big of a benefit is it?
It's huge. This is not a great comparison, but think about how the equity markets have evolved over time, for example, just listed securities. And you think about in the height of the meme stock frenzy, for example, Citadel Securities had told us that 25% of the market was made up of retail traders at the end of the day. That marginal buyer could be very meaningful over time. But again, there's a process here. This has to be a sense of the SEC approving these ETFs. There's another element of this here too, and remember, it's the fee structure. Because if you look at the expense ratio of the Grayscale Bitcoin Trust as it stands today, it's 2%. Relative to ETFs, that is, or a standard kind of equity ETF, that is much, much higher than you're seeing the several basis points you see at some of the more liquid ETFs tied to ordinary stocks. So the price, and even Grayscale has said this, that over time there's going to be compression in fees when it's tied to the products that are entering the Bitcoin market, which is another way that people can be drawn into the market.
Okay, so that news, again, that you have a U.S. court paving the way for the first Bitcoin ETF in a Grayscale ruling. SEC said, nope, you can't have a Bitcoin ETF, you can't convert, and now U.S. Court of Appeals saying, yeah, actually, we think you can. Shonali, amazing stuff. Did you have breakfast yet? Did this happen?
I had a granola bar in
between. Okay, because she was like running from hit to hit here with all the breaking news. All right, Shonali,
Sally Bassick, thanks very much. We really appreciate it. Bitcoin jumping, Grayscale Trust jumping. We will continue this conversation as well. All right, coming up, July job openings in the U.S. falling to a 2-year low. We're going to take a look at trends in the U.S. labor market with Nancy Vanden Houten of Oxford Economics. This is Bloomberg. A big week for pretty much all data in the U.S. For jobs in particular, at the top of the hour, we got JOLTS, which showed job openings falling in July, but below 9 million. Now, later this week, we get ADP, monthly payrolls number on Friday as well. So I want to get a check-in on how the labor market's actually doing. Nancy Vanden Houten of Oxford Economics joins us now. Nancy, what did you make of the data that we got at the top of the hour of JOLTS? Like, is that enough of a signal to make the Fed feel okay about where the jobs market is?
Yes, I think so. In the JOLTS data, we saw, as you mentioned, job openings decline. The quits rate also came down, and that's a reliable leading indicator of where wage growth is going. That ratio of job openings to unemployed workers is also coming down. All of these things remain consistent with a labor market that we would still describe as tight, but definitely loosening and moving in the direction that the Fed would like to see.
What do you want to see, Nancy, to say not only is it moving in the right direction, but it's there? It's at the place that the Fed would like it to be at?
Well, I think that this morning's JOLTS report and what we're expecting for payroll employment on Friday will be enough to keep the Fed on hold at its meeting in September. The Fed has made clear, most recently Powell at Jackson Hole on Friday, that they're still committed to seeing inflation return to its 2% target. They'll want to see even slower job growth than we're seeing now. But, I don't think that the Fed, needs to see us at the destination before they stop tightening, as long as they see things moving in the right direction.
Nancy, I'm worried. I'm interested in the stuff under the data that we don't necessarily get headline reads for. And the Journal had a really interesting article out over the weekend talking about quiet cutting. Not the quiet quitting, but the quiet cutting, where you kind of get rid of a department and move those people somewhere else in a company in a job they might not want, which kind of in essence moves them to quit without having to pay severance, etc. Is that a real thing that could be distorting some of the data?
I think that that's a one piece of evidence, anecdotal evidence, that perhaps workers have a little less leverage than they had, say, a year ago, and can be, viewed as one additional sign that conditions in the labor market are loosening up. Perhaps another indicator like that might be the number of employers who are feeling more comfortable requiring workers to come into the office, and they're being less generous with remote work options.
Nancy, is the data also distorted by the response rate? I'm just looking at it. It's only above 30%. It's been falling pretty precipitously for the JOLTS data report. How much can we trust it if responses are low?
Well, this is what we've got to work with. So yes, the response rate is low. There have been months in which the response rate to the payroll employment, particularly on the first go-round, have been on the low side. But I think that we have to look at everything and taken together. There are a lot of indications that conditions in the labor market are cooling off a bit, and that's definitely the direction the Fed wants to see things going in.
Then on the flip side, we have, say, the United Auto Workers potential strike with the big three, which, the headlines crossed last week, but if you talk to people who were around during the bailouts, they feel like this is a really big deal and a really bad thing that could actually unfold. You're looking at a 46% ask of salary. Nancy, are we in a wage price spiral here, or when you look at those headlines, is that an auto idiosyncratic problem?
Well, we have, seen, other recent, circumstances where, workers such as at UPS have gotten some, relatively generous compensation packages. So, I think, no, I don't think we're in a wage price spiral. It seems in some instances that workers, particularly those represented by unions, are being able to negotiate some favorable, compensation packages. But I don't think that economy-wide, the percent of workers represented by, unions is still relatively low compared to what it was many decades ago. And so I don't think this is, an economy-wide phenomenon.
So JOLTS data moving in the right direction for the Fed, not a wage price spiral. The consumer confidence numbers also weren't so great just 48 minutes ago. Can we start talking about a slowdown in consumer spending yet, Nancy? Are we there?
I think we're moving in that direction. I don't think we're there yet, because we, most recently saw a very, strong consumer spending number for July. But I do think that there are a number of signs that the consumer is going to start to run out of gas. Income growth has been strong, and it's still a plus for consumer spending. But we think that stockpile of excess savings is diminishing. Consumers, some households, we know that circumstances differ among households, but some, I think, may be, running out of room to borrow. Lending standards for things like credit cards and auto loans are tightening. We're seeing some pickup in delinquencies and for those types of borrowing. And also, the student loan forbearance program is ending later this week, and we think that will also take a bit of a toll on consumer spending. So we definitely think that the consumer is going to start stepping back a bit more in the months ahead.
Nancy, really great to get your thoughts today. Nancy Vanden Houten of Oxford Economics. Coming up, China's biggest banks are getting ready to cut interest rates on existing mortgages again. More on the country's efforts to stimulate the economy next. This is Bloomberg.
When we ask sort of what data jolts the market this week, one glaring answer is anything that happens out of China. So the country is still taking some steps to try and stimulate its economy, but it feels like a drip feed here. The latest move in that banks in the country are looking to reduce rates yet again. Joining us now is Bloomberg's Enda Curran in Washington. And the market wants a big bazooka. I guess they mean the same thing. They want a bazooka. They're getting a drip feed. When is that going to change?
Absolutely, Alex. The entire world is looking at China's economy and wondering when will it turn. But like you mentioned, the latest measure is that the banks are being encouraged to bring down their deposit rates. And the idea being that if you're offering lower rates, well, people will take their money out and go and spend it on the high street via consumption, or they might go off and invest it in the stock market or somewhere else and kind of stoke animal spirits. But as you say, this is kind of being interpreted as another piecemeal kind of approach. The property slowdown, which is at the crux of China's big slowdown, really isn't showing any signs of turning around yet in terms of demand and prices for property and the like. And the government is sticking with a pretty restrained approach. I mean, those people who've been conditioned for years of massive China stimulus, they're not yet rolling it out, and they haven't intimated that they're going to do so anytime soon either.
Well, what is the calculus of staying with the smaller approach? What are Chinese officials trying to prevent by not doing something massive at this point?
Well, you know, if you go back a step, remember the narrative in China's economy for years was there's too much debt in the system. They've got to control that. They've got to control risks in the banking system. Of course, the real estate sector was identified as a bubble. All of these were warning signs in China's economy. And of course, the authorities have taken steps to try and rein all of that in. And the result has been a lot of pain in the property sector, in the credit markets for those big for those big property developers in particular. So on paper, you could say, the benign interpretation is the government is pursuing this to get the economy back on a sustainable footing. But of course, that means there's a lot of pain in the near term, and whether or not they're willing to cross that threshold, put that to one side for the time being and start tipping more money back into the economy through, more borrowing, more public spending is the big question. I would say though, Danny, away from the real estate sector, take a look at what's going on in iron ore. Iron ore prices and volumes to China holding up very well, and that suggests that the infrastructure spending side, the investment side of China's economy is actually holding up a bit better than expected, and that's kind of getting lost in the current narrative.
Yeah, or are they stockpiling and it's distorting? I don't know. And hey, thanks a lot. Always appreciate it. Thank you very much, Enda Curran, joining us in D.C. All right, to the story that we're all still talking about is in the world of football. And by football, I mean soccer. Trouble still mounting for the Spanish football president, Luis Rubiales. Top officials in the federation he leads are now calling for his resignation after Rubiales kissed a player on the lips at the Women's World Cup final. Meanwhile, his mother is still in the midst of her hunger strike at a church in southern Spain, protesting what she calls the inhumane hounding of her son. Danny, I know you've been on vacation, but were you up on this? This was literally all I was talking about for the last few days.
Yeah, I know I shouldn't be saying this as someone who literally does news for a living, but I kind of switched off and didn't pay attention to anything, literally except for the story, because I could not avoid it. I mean, it's kind of sad. I did watch the World Cup final. I thought that would be the conversation, but it wasn't. It was this. It overshadowed it. I did see, though, that the Labor Minister of Spain has sent a letter to football clubs in Spain saying you need to justify why women's pay is so much lower. Obviously, none of what's happened is good, but this is potentially a good thing that could happen with more focus on sexism and inequality in football.
Yep, absolutely. We've been hearing that in pretty much every sport all over the place, so 100%.
All right, Alex, we are near the end of the hour, so I want to give us a quick look at how European markets are shaping up, because we saw that turnaround in U.S. markets. Look, it's happening here in Europe. European stocks were already higher to start the day. It did get a lift from China. I know we're just talking to Enda about how not too much moved, but stocks, hey, they seem to like it. At least something did. Of course, volumes are light. European equities up 0.9%. Sterling, that is weaker versus the dollar. It did kind of waver with that JOLTS data. Same goes for the euro, but that's still holding on to strength. Okay, coming up, we're going to be speaking with Skylar Montgomery-Koning, Director of Macro Strategy at TS Lombard. It's Tuesday, the 29th of August. Weaker JOLTS data sends stocks and bonds higher. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Minutes ago until the end of cash equity trading here in Europe. I'm Danny Berger in for Guy Johnson. Alex Steele is in New York. Look, we had JOLTS data about an hour ago, around 9 million, let's call it, job openings. Previously, it was well above 9 million. So that is the right trajectory of what the Fed wants. That bad news, good news for equities. It ripples through to Europe. European equities almost higher by 1%. They were already higher. Some China news helping with that ever so slightly. The FX market, it's been a little bit more complicated. Both sterling and the euro spent the day, for most of the day, declining versus the dollar. Both of them were heading to their weakest level since June. Now, as soon as that data hit, you got a reversal in the dollar. Both sterling and the euro were higher. Again, volatility, low volumes. You know, it's August. Strange things happen. You get sterling still dropping versus the dollar, but euro has been able to hold on to some of that strength in the immediate aftermath of the JOLTS figures, Alex.
Yeah, and not only that, we also got consumer confidence, which really started to slip over as well. And then it's really things like higher food costs, gasoline costs, worries about the job market kind of feeding through. So all of that impacting the price action. I'm with Annie, though. I'm not taking this price action too seriously. But nonetheless, S&P up solidly, 0.7 of 1%. The Nasdaq 100 flying higher at this point, up by 1.5%. The reason, obviously, the drop in yields, a huge rush into the bond market on the front end. You get a 7-note auction coming at 1, and that's about $36 billion. And the dollar index, I mean, it doesn't look very dramatic at this point, but if you look at an intraday chart, it was a drop in like a stone, and then now we're back up a little bit, so we're neutral on the day. But volume was so bad yesterday. The volume is not great today, so I'm very skeptical as looking into a true market reaction and Fed feel, even though, Danny, like swaps are now looking at a cut in June versus July after the data. That's a bit of a head scratcher.
It is a head scratcher, but it's almost like, Alex, you knew exactly the chart.
It's like we planned it.
That is, it's like we planned it, or maybe it's just TV magic. You get to decide, our lovely viewers, which one it is. Okay, look, I have a chart in front of me. I actually recommend pulling this up on your terminal so you can see it better. It's 684 on your terminal, of volume, of what we've seen so far, of an S&P that finally locks in 2 back-to-back days of gains for the month of August. Again, we haven't seen that so far this month. It looks like we're headed for a third day based on everything Alex and I were just talking about. But if you look in the bottom half of this chart, it's daily volumes. This is the A plus B plus C tape volume all collated together. Yesterday we saw a volume of 450 million. Now that is the lowest data we have seen this year if you strip out some of those half days. It really just shows that, okay, yes, we gained, but on how much conviction, how much of this market, Alex, isn't just seasonality, isn't just summer doldrums, but I mean, it's also the end of the month. There's potentially some rebalancing coming through. So how much of it can you actually trust, and just how volatile might the market be with the week ahead?
Yes, and not even that, but then you get September, which is notoriously a terrible month for returns for stocks. That point, though, there is a lot happening, a lot of data coming out. Just look at the volatility that we got with the JOLTS data and consumer confidence, and we get it from lots of different places. We get it from Japan, from China, from Europe, as well as the U.S. If we take a look at the week ahead, right? European inflation, that's going to be key. China PMIs, that's going to be key. Japan, you got retail sales, profits for companies, and really what happens with the yen if the dollar continues to trade stronger. And in the U.S., it's all of it. It's inflation, it's ISM, and it's jobs, Danny. So there is a lot that could actually wind up affecting these markets.
I'm so impressed you actually got through all that data in, what, less than a minute? Like, it's enough data to talk about for the rest of the show, so that was very impressive, Alex.
Guy's on vacation, like, that's why. Otherwise, it would have been very different.
Well, yeah, if Guy was doing it, yeah, we would have had to take a quick nap. All right, not to make fun of Guy, let's talk about our question of the day. I feel like someone's going to show this to him, and I'm never going to be allowed to babysit the show for him, so I fear that. Anyway, let's move on quickly. What data shakes the market? Potentially, we already got it with the JOLTS data, but we have a lot more to come, as Alex was just outlining. Let's get now to Bloomberg's international economics and policy correspondent, Michael McKee, and Ven Ram from our MLive team. Ven, let me start with you. What data is most likely to shake this market, or did we already just get it?
I think we are getting it in drips and bits and pieces, Danny, but I think there's more to come. Everyone is talking about China. China, of course, is important, but I'll tell you what I'm watching, and what I'm watching is the real neutral rate in the US. According to a recent Fed research piece, the real neutral rate is headed towards 2.5% by the end of the year in the US. If that is true, then if you've got core inflation, core PCE running at 4.1%, you're talking about a Fed funds rate above 6%. Now, that is not priced anywhere into the markets. Of course, we got the JOLTS data that shows weakness in the economy, that shows that the labor market is kind of coming into balance. We saw consumer sentiment declining as well. Those are all small bits and pieces of the bigger puzzle that the Fed is looking to solve, which is a labor market that is completely aligned in terms of demand and supply. And we are not seeing that yet. And therefore, that data point is crucial.
Mike, what do you think?
I think that makes a lot of sense, but we'll get some inflation data that will matter on Thursday, maybe even more than the jobs report on Friday, because the PCE index is what the Fed follows, and they target the headline, but they're looking at the core. Both of those are expected to go up a little bit, which will keep that real rate from rising as much as it otherwise would. If we get a surprise and inflation falls, then you have more of that problem. Obviously, jobs is going to be important. It's really going to be the level of jobs that people are looking at, because the unemployment rate not expected to change. But if we do see a surprisingly higher jobs number, then just imagine what the volatility will be like at the Hampton Stock Exchange.
Oh yeah. Nice.
I fear that. It's August. It's the end of August. We should all be on a beach somewhere. Alas, we are not. Mike, is any of this data likely to change